Dear investors, in our last investment commentary, we discussed the recent turbulence in financial markets. We want to give our clients an update on what the outlook for the remainder of the year may be and what we, as your chosen professional discretionary fund manager, are doing to manage and protect your assets. As a reminder, the recent downturn in financial markets has been caused primarily by fast and somewhat unexpected inflation. These supply and demand pressures are a fallout from the pandemic of 2020. Many economists and analysts had expected supply chain issues to have reduced gradually by now and had perhaps underestimated the long-term inflationary impact of emergency quantitative easing that were put in place during the pandemic. In fact, the impact of quantitative easing and COVID issues still persist in many parts of the world. This is particularly evident in China, which is the world's second largest economy and a major exporter. These issues were then exacerbated further by the conflict in Ukraine in February. Central banks and governments are now scrambling to counter this increase in everyday living prices by increasing interest rates and introducing new fiscal policies. UK inflation has now reached its highest level since the early 1990s, nearly 9% annualized growth. The US Federal Reserve, the UK Bank of England, and European Central Bank have all followed one another in raising interest rates in successive months. The real trick for them is not to raise rates too much or too quickly so as to instigate a recession. Many economists have theorized that a sustained period of high interest rates will be needed in order to bring inflation under control. Over the last decade, financial markets have become used to very low interest rates. Rising inflation impacts the earnings of companies that cannot pass on their input costs to the end user, and particularly growth companies, which are valued at many multiples of their expected future earnings. As a result, since the start of the year, many major developed stock markets have fallen. There are some green shoots, however. China is reopening its major cities, which it locked down as part of its zero COVID policy. This should substantially help global trade. In Europe, despite the conflict in Ukraine, the latest business confidence data measures in the Eurozone have held up and unemployment continues to be relatively low. In the US, recent data continues to support strong underlying economic activity, both within manufacturing and service sectors, but also in terms of consumption by supplies of microchips, which were a bottleneck to many high-end consumer goods, including the automotive industry, are coming back on tap. Shipping container costs are starting to reduce, and fertilizer costs, which are an important part of modern agriculture, are also decreasing. So, what have we done to protect your money during this period of high volatility? In short, we initially increased the level of cash within portfolios to mitigate any further falls the market might experience. In early May, our analysis indicated that markets may have further to fall and inflation was still yet to peak. Unfortunately, we still think a global recession is in process. We have then used some of these cash reserves to increase commercial property exposure and to purchase a market neutral fund. Commercial property tends to do well during higher inflation as higher rents can be collected from tenants. And the market neutral fund is designed to attain gains regardless of general market direction. Understandably, our clients are concerned at this time. It is important to remember that with all investing, it is key to have a long-term mindset and to have the confidence that history teaches us markets have an incredible power to resolve and recover. The most recent crisis of 2008 and 2020 are two such examples. Over the last 15 years, markets have on average recovered within just 3 months. Whilst we do not think that this will happen in this current situation, it does show the power of markets to recover in a relatively short period of time. We encourage interaction with your financial advisor, whom will assess your runway to retirement, for which for many of our investors is still many years away. It is important for us and our investors to set our expectations for the remainder of the year. Having enjoyed several consecutive years of positive growth, we now have to be prepared to experience a year of stagnant or possibly even negative growth. We will, of course, as your appointed professional discretionary fund manager, keep abreast of the latest developments in the global financial markets and manage your portfolio. If you have any questions, please do not hesitate to get in touch with your financial advisor or directly with us on the email at the bottom of the screen. Thank you.